3 to 6 months of expenses. Put that away before you start splurging and doing other things like that, right? The emergency fund. But in the article, it tried to talk about asset poor. I didn't even hear about asset poverty, anything about assets, until Mr. Kiyosaki started teaching about the true meaning of an asset and a liability. That's really another way to confuse you, all right? Just stay with those things that are simple, all right? All right, now, trying to go too far here. Budget tip number 3. My assets pay for my liabilities. Now, let's get the budget tip number 4. I don't want to skip that far. Yeah, I don't want to skip that far. My assets pay for my liabilities. Well, this is what Mr. Kiyosaki encouraged. If someone wants luxury goods, or if you want to acquire goods and things that are beyond food, clothing, and shelter. Those are what they call necessities. Am I correct?
Yeah.
Necessities of life. Okay. But when you want to go beyond that, what he taught, what he encouraged, and what his rich dad taught him, it says, well, there's a process to where you can achieve this. He said his rich dad, his poor dad would always say, when he talked about luxury things like that, well, I can't afford that. We can't afford it. But his rich dad said, no, let's look at how can I afford it. Big difference, all right? When you say you can't do something, you just turn off. You don't try. You don't search out a way to try to achieve it. You just dismiss it, all right? And that's what his poor dad would always tell him. And that's his highly educated dad now. The one who was the director of education for the state of Hawaii. That's the kind of thinking he had. All right. His poor dad, his rich dad said, no, let's see how I can do it. How can I afford it? All right? Big difference. So, of course, what his rich dad said, he acquired assets first. Income-producing assets first. And then he used those assets to pay for his luxuries. So if he wanted let's just think about today. If he had a Ford, but he wants a Cadillac. All right? He didn't go out and buy the Cadillac, even if he had the money to buy the Cadillac. All right? That's not what he did. What he would do first is, either he would buy stock, or he invest in some property, whatever, and the income from the property, or the income from the stocks, he used that income to buy whatever that luxury good is, Cadillac or whatever it is, all right? And by doing that, you know cars, when you drive them off the lot, they depreciate in, 25% they depreciated, right? You've lost 25% of the value of the vehicle once you drove it off the lot. If you use your own hard-earned money to do that with, all right, look what you've done. But if you use income from an asset that continue to produce income for you, and you use that money to do it, yes, the car's appreciated, but you still got money coming in from that asset. Now, if it's an apartment building and you got tenants there, you're still paying rent. So you still have income coming from that property. If you're lucky enough to get in on Facebook's IPO, how many of y'all know about Facebook and their initial public offering? Okay. Now, do y'all read the newspaper? Do y'all listen to the news? Because there's no way in the world everybody should have raised their hands. Everybody should have raised their hands in here now. If you have not heard about Facebook, none of us can get it. I wish I could have got in on the deal. Okay. But if you don't understand, and you haven't heard about that, and they getting ready to get what IPO is an initial public offering, all right? And all those who were able to get that stuff early on, they're beginning to become millionaires so many times over. All right. That's in terms of the way they're going to value that company. All right. But anyway, this is what investors do. Okay. This is what they do. Or I was going to use this example for something later, but let me use it now. Mitt Romney. Most of y'all know who Mitt Romney is, right? Okay. Most of y'all know who Mitt Romney is, right? Okay. All right. And you know how he's made his money? How did he make his money? He managed what? He managed investments. So what was the name? What kind of company did he manage? What was the name of the company? What did they do? A private equity. They're not consultants, but private equity company. Private equity company. And what did they do?
buy out small companies.
They buy businesses. They buy businesses and whose money do they use?
Other people.
Little of their money, but most other people's money. All right? Most other people's money. You know, I talked about that before, right? Using other people's money. People go, can you really use other people's money? That's all they do is use other people's money. Because none of us have enough of it to do it ourselves, you know. But neither do they. All right? Get the business going. Get it up. Sometimes they have to fire folks. This is where you got in trouble with his mouth, you know, because they do that. They're trying to get it profitable, and then they sell the business at a profit. Am I correct?
Yes.
Right. That's how they make their money. Now look how he structured his pay, though. What did he say the percentage of taxes he pays?
14%.
About 13-14%, right?
Yes.
Off of how much money did he make? How much money did he make for the last 2 years?
Several million.
Over $1 million.
Not just several. About 40, about 20 million a year. 20 million a year. About $40 million. But he got it structured in such a way that he gets it from the profit, not as a salary. So he doesn't pay the same taxes that you would pay on what they call the capital gain. Now I know I'm leaving some of you all, but just stay with me, all right? He structured it so that he gets it from the profit. And the way it comes, it's not like he's getting a salary. So he's able to pay the lower interest rate. Now, let me tell you something. It's legal. Yeah, it's tax rate, I'm sorry. It's legal. But who wrote the law? Who in the city? Who wrote the law? Oh, and they're all wealthy. You know, yeah, it's legal. Now, I ain't mad at them. I just want to know how they did it. you know, some of us will complain. Oh, that's wrong. Well, if they can change the law, fine. But until they change it, I want to see how they did it. So we can do it the same thing. You know, laws are applied to everybody. You just need to know how it works. Don't try to fight against something that, if it's legal, just figure out, okay, now wait a minute. How can I get in on this? You know, and the guy who started the company, this company called Bain, I think it was Blaine Investments or whatever. That's what they did. All right. So, but again, using assets to purchase your liability. So if you want, he used Robert Kiyosaki. He used in the example. He used a Bentley. He wanted to get a Bentley, so he set up a Bentley account. Now, whatever you want to do, just set that account up. All right. And now look at investments. You can start a business. You can start, you invest in real estate or whatever. But invest in something so that the proceeds from that, the income from that, then you put that money into the Bentley account or whatever it is, a house account or whatever that luxury goods you want. You want to go to Hawaii for a month, whatever the cost is, set that account up for that. All right. Don't go into debt doing it. Set an account up for it, and then once you have the money that you earn from that investment, buy the Bentley, buy the Cadillac, go to Hawaii, because when you get back, you don't have no debt. And you still got the investment continue to earn money and income for you. You see what I'm talking about? All right. That's what they did. And that's what they've done. And that's what he's teaching in the book. And so that's what I want to bring to you. So, your assets pay for liabilities. Use the cash flow from the asset to purchase that luxury liability. All right. So, you say, how do you build assets? You acquire assets by paying yourself first. Now, we talked about this at the last first Sunday. Pay yourself first. And how many people remember the scenario I used, you can pay yourself first? I used something simple. I used 3. How many people were here last time that I talked? Okay. Do you remember that? I said, start with 3.
You're talking about like zakat.
There you go. Come on with it.
Investment.
And savings. But what did you put them in? 3 what?
3 cups.
Oh, 3 cups, 3 piggy banks. I just said 3 piggy banks. Right? I said you can start with 3 piggy banks at home if you want to do that. Or you can start and you can just transfer the money when you get paid. Before you use it, transfer it into accounts. Okay? Name 1 for savings, 1 for zakat, or charity, 1 for investments. All right? And so you can start with $1 in each one. Every